Welcome back to the Deep End. Today on Talk Tickers, we are dissecting just a classic Wall Street collision.
A collision is right.
You've got this unstoppable force of the AI infrastructure boom.
Crashing right into the immovable object of industrial friction.
Exactly. We are breaking down the Q4 2026 earnings print for Eaton Corporation, ticker ETN.
And if you were watching the tape this morning, you didn't just see a collision, you saw, well, it looked like a crime scene for a minute there.
It was ugly. I honestly thought there was a typo in the press release for a second.
It really felt like it. The stock gapped down, 5 or 6% in the pre-market?
Something like that, yeah. The second the print hit the wire.
But then something interesting happened.
Yeah, it did.
It spent the entire trading session clawing its way back, just scraping and fighting to actually close green.
Up 0.86% at $362.53.
Which is just a massive intraday reversal for a so-called boring industrial giant.
Right. Usually when a company like Eaton misses revenue and guides soft, they stay in the penalty box for a while. They don't. They don't bounce back by lunch.
And that's the deep dive today, isn't it? Why did it bounce? It's really a tale of two narratives.
Okay.
On one hand, you have this industrial hangover. The vehicle business is just dragging them down, and it's led to a huge strategic breakup announcement.
And on the other hand,
the AI gold rush. I mean, liquid cooling, data centers, and a backlog so long it almost sounds made up.
So we're going to unpack the spin-off, the physics of that liquid cooling piece, and why the market freaked out over the guidance. But first, let's just start with the report itself. What actually hit the tape to cause that initial panic?
So let's look at the headline numbers. Adjusted earnings per share, or EPS, came in at $3.33.
$3.33, and what was the street looking for?
Consensus was at $3.29, so a decent beat there. That's up about 18% year over year.
Okay, so profits are up, the bottom line is healthy.
Profits are up, but the top line, a little softer. Revenue was $7.06 billion.
Which is still up, what, 13%?
It is, and that's objectively healthy growth for a company this size. But it was a slight miss against the $7.09 billion Wall Street wanted.
So a slight revenue miss, a slight earnings beat. I mean, that sounds like a hold, not a dump the stock kind of moment. What was the real catalyst for the sell-off?
The devil was in the guidance. That's where the algorithms tripped.
Always is.
Eaton released their full year 2026 outlook. They guided EPS to a range of $13 to $13.50.
Okay, so the midpoint there is $13.25.
Right. And the problem, the LSEG consensus estimate, what all the analysts were modeling, was higher than that.
So the street just got way ahead of its skis. They priced in perfection, and Eaton gave them, well, they gave them reality.
Exactly. And the Q1 guide, specifically the immediate future, was soft. They told us margins are going to step down sequentially to about 22.4%.
So investors see missed revenue, lower margins next quarter, and they just hit the sell button, no questions asked.
Instantly. But they hit the buy button later, which implies that once people actually read the report, they found something they liked.
Which brings us to the elephant in the room, the strategic bombshell. Eaton is breaking up.
They are. They are officially spinning off the mobility group. That includes the vehicle and the eMobility segments, all into a standalone public company.
This feels like it's been coming for a long, long time. We've been tracking this divergence in their segments for a while now. It feels like Eaton has been two companies sewn together.
It's exactly that. A high-tech electrical grid company and an old-school auto parts manufacturer.
And this was a necessary divorce?
Totally. I mean, if you look at the performance this quarter, the contrast is just, it's stark.
Lay it out for us.
Okay, so in the Electrical Americas segment, orders are up 16% on a rolling 12-month basis.
Strong.
Aerospace orders up 11%. These are double-digit growth engines.
And the car business?
The anchor. Vehicle organic sales were down 13% in the quarter. eMobility, even worse, down 17%.
Ouch, down 17%. That's not just a slowdown, that's a contraction. That is bleeding.
And it creates a huge drag on the overall growth profile. But more importantly, for you holding the stock, it compresses the valuation multiple.
Let's just define that for a second. When we talk about multiple compression, we're saying the market just refuses to pay a premium price for the whole company because of the bad parts.
Right. Think of it this way. The market's willing to pay, say, 30 times earnings for a data center AI company because it's high growth, right?
Right.
But it's only willing to pay maybe 10 times earnings for a cyclical auto supplier because it's low growth, and risky.
So as long as Eaton owns the auto business, the market won't give them that full data center valuation. They're stuck with a discount.
Exactly. So by spinning it off, they're basically screaming at the market, stop judging us by our transmission business. Judge us by our grid business.
So Eaton becomes a pure play, secular growth asset. Grid, aerospace, data center.
And the new Mobility Co. becomes its own thing. It'll be a roughly $3 billion revenue business. It's solid, it's cash generative, but it belongs in a different basket.
So if I'm an investor, I stop seeing the industrial conglomerate discount.
And you start seeing the tech infrastructure premium.
That's the theory. And that's likely why the stock recovered. Investors realize this spinoff unlocks a ton of value. It just simplifies the whole story.
Yeah.
Okay, so we're cutting the anchor. Now let's talk about the speedboat, the data center business. I was reading through the transcript, and the numbers here are frankly ridiculous. Are they sustainable?
They are staggering numbers. Data center orders accelerated approximately 200% year over year.
200%. That's not a typo.
It's not. And revenue in that vertical is up about 40% compared to Q4 of last year.
That's not normal industrial growth. That's software growth. That's NVIDIA level growth.
It is. And management spent a significant amount of time on the call distinguishing between two concepts that are, I think, critical to understanding their moat, the inner loop and the outer loop of cooling.
I saw this. It feels a little like marketing jargon, but you think it matters.
It matters immensely. It's the difference between being an HVAC repairman and being a chip architect.
Okay, break it down for me. What is the outer loop?
The outer loop is the facilities level. So think of the big chillers outside the data center, the massive air handling units on the roof.
Okay.
Eaton partners there. They sell power to those units, but that's not their primary battleground. That's a crowded market with players like Carrier or Trane.
So that's the air conditioning for the building? Keeps the room cool? What's the inner loop?
The inner loop is the white space. It's the equipment that is physically closest to the chip, or right inside the server rack. We're talking about cold plates that sit directly on top of the GPU.
Okay.
The coolant distribution units, or CDUs, and all the manifolds that route the liquid.
And this is where that recent acquisition comes in, right? Boyd Thermal?
Correct. This is why the Boyd acquisition is so critical. By acquiring Boyd, Eaton bought the leader in that inner loop technology. They bought the plumbing that touches the brain.
Okay, but why does being closer to the chip matter so much? Why can't they just blast more air conditioning from the ceiling?
Physics. It comes down to physics. Management actually addressed the recent news from chip makers like NVIDIA explicitly.
Right, the next-gen chips.
Yeah, they're running hotter. There was this fear in the market that maybe new chips would become so efficient they'd need less cooling.
Right, the efficiency argument.
Right.
Better chips use less power.
It's actually the opposite. The heat density, the amount of heat generated in a tiny square inch of silicon, is getting so high that air cooling, the outer loop, physically cannot handle it.
Air's just not a good enough conductor.
Not anymore. You need liquid rejection right at the source.
So even if the chip architecture changes, the laws of thermodynamics don't. You have to move that heat away from the silicon, and that is what the inner loop does.
Precisely. And here's the financial kicker. Management stated that with the Boyd acquisition, their accessible market per megawatt of data center capacity jumps from $2.9 million to $3.4 million.
Whoa, hang on. That is a massive increase in wallet share. They're capturing $500,000 more for every single megawatt of data center built just by owning the cooling tech.
Yes. And when you multiply that extra $500,000 per megawatt by the sheer scale of this build-out, the numbers just get silly.
Let's talk about that scale, because the backlog number they dropped was the moment I did a double take.
The 11 years comment.
11 years. They said the data center construction backlog represents 11 years of building at 2025 rates. That implies we're in, what, inning one of a 9-inning game?
Or maybe the pregame warm-ups. This is why the dip was bought so aggressively. When people worry about, is the AI trade over? Or is the cycle peaking? Eaton is sitting there saying, we have orders booked out for a decade.
That is just incredible visibility. But, and here's the friction. We have to be critical here. If the backlog is so good and the orders are up 200% and they own the physics of the grid, why is the guidance for 2026 sorta?
Right. Why are margins stepping down in Q1?
Yeah.
This is the margin headwind theme. It sounds counterintuitive, but the guidance is light because the growth is so strong.
Walk me through that, because usually high growth means high margins. Operating leverage, right? You sell more widgets, you make more money on each one.
Eventually, yes. But right now, Eaton is in the investment phase. They announced $1.5 billion in investments to build new factories, expand production lines. You can't just flip a switch and have a new factory appear.
Right. Concrete takes time to dry, machines take time to install.
And people take time to train. Management mentioned they're deploying Tiger teams. These are specialized groups of experts sent to these new sites to accelerate the ramp up.
And that costs money. Travel, overtime, consulting fees.
So they're incurring all the costs of running the factory. Salaries, depreciation, electricity, Tiger teams, before the revenue from that factory fully kicks in.
Got it.
They estimated this manufacturing drag will hit margins by approximately 130 basis points in 2026.
130 basis points that's 1.3%. In the world of industrial margins, that is huge. That's the difference between a beat and a miss.
And it's front-loaded. They said 44% of their EPS comes in the first half of the year and 56% in the second half. The margin compression is happening right now in Q1 and Q2 as they hire ahead of the sales curve.
So the bear case is margins are falling. But the bull case is margins are falling because they're preparing to sell 200% more stuff later.
Correct. And consider this. Despite this drag, the Electrical Americas business is still printing margins around 30%. That's incredibly resilient.
So the bet investors are making is that once these factories are fully online,
Later in 26 and into 27,
the operating leverage is going to rip higher.
it's like a coiled spring. You press it down to load it up. The costs are the pressure, and the profit is the release.
That's a perfect analogy. And it's not just data centers loading that spring, is it? We have to touch on the mega project backdrop.
The $3 trillion figure.
I saw that in the notes. That number is hard to even wrap your head around.
It is abstract, right? But let's make it concrete. They're tracking 866 mega projects. These are projects worth over $1 billion each. The total value is $3 trillion.
And how much of that is Eaton actually bidding on?
Their negotiation pipeline, so deals they're actively working on, is nearly $10 billion. That's up 4x since 2019.
Wow.
And the backlog for Electrical Americas is up 31% year over year to an all-time record of $13.2 billion.
This brings us back to the visibility point. In an uncertain macro environment, Eaton seems to know exactly what they're going to be doing for the next 2 years.
And don't sleep on aerospace. Everyone focuses on data centers because it's sexy. But commercial aerospace growth expectations were raised to strong double-digit. The defense aftermarket is also doing great. It's a dual-engine growth story now, especially after they spit off the car parts.
So bringing this all back to the investor context, we have a stock that's expensive relative to its history. It had a sell the news moment on the guidance, but it recovered. What is the market psychology here?
It's a battle between valuation and momentum. The stock is not cheap, but that backlog provides a floor. And the market is also starting to sniff out a beat and raise setup.
Ah, the classic sandbag. Under-promise so you can look like a genius later.
Management basically hinted that their 2030 targets, which call for 6 to 9% growth, have upside by guiding conservatively on the 2026 ramp.
Baking in all the costs, but maybe not all the revenue velocity.
They've set themselves up to underpromise and overdeliver in the back half of the year.
That makes a ton of sense. If you know Q1 is going to be messy with construction costs, you lower the bar so you can step over it later. But there is one capital allocation note we should mention. They suspended share buybacks for 2026.
Right. This is to pay for the Boyd acquisition.
That creates a temporary vacuum, doesn't it? Usually, if the stock dips, the company steps in and buys back shares, which supports the price. That support isn't there right now.
So the onus is entirely on earnings growth to drive the stock price. You have to believe in the organic growth machine because the financial engineering is off the table for the next 12 months.
It's a pure execution story now. No tricks, just sales.
It is. It's a transformation year. 2026 is the year they build the capacity to dominate the 2027 to 2030 cycle.
Which brings us to my favorite part of the show. We've looked at the facts, we've parsed the management speak. Now it's time for the segment where we throw caution to the wind.
All right.
Please remember, legal requires me to say this. This is not financial advice. Do not do this. This is for entertainment purposes only. If you lose money, don't call us.
Okay, what have you got for us today?
I call this trade pitch the thermodynamic arbitrage. Or, if you want a catchier title, the SpinCo leapfrog.
Okay, I'm listening. What's the setup?
The setup is that the market hates uncertainty. Right now, Eaton is messy. It has this auto business attached to it like a barnacle.
Yeah.
It has margins compressing because they're building factories. It looks expensive.
So where's the arbitrage?
The arbitrage is in the re-rating. Step 1. You go long Eaton aggressively, but you do it via Lucas long-term equity anticipation securities, and you buy the ones that expire after the mobility spin is complete.
So you're buying the option to own the new Eaton in the future, skipping the messiness of today.
Exactly. You are buying a coiled spring. The moment the mobility business, that low-margin anchor, is cut loose, Eaton instantly stops trading as an industrial conglomerate.
And starts trading as a data center infrastructure company.
Yes, you're betting on the multiple expansion, the PE ratio going from, say, 25 to 35.
No.
But here's the kicker. At the same time, you short a basket of outer loop legacy HVAC providers, the traditional chiller companies.
Oh, that is aggressive. Why short them?
Because the interloop is eating the value chain. As heat density goes up, traditional air cooling becomes less and less relevant. The value shifts from the air conditioner on the roof to the cold plate on the chip.
Which Eaton owns via Boyd.
You're betting that Eaton becomes the NVIDIA of grid physics.
The NVIDIA of grid physics. That is quite a title.
Think about it. By 2027, if they execute, they aren't an electrical company. They are a tech infrastructure monopoly. And once that heavy CapEx cycle turns into free cash flow, it's a money printer.
It is outrageous, but physically it's plausible. If the heat density trends continue, the money has to flow to the liquid cooling solutions. And shedding the auto business just removes all the noise. It's a high beta bet on the future of compute.
Exactly. A wild idea, but that's what we do here.
So bringing us back to reality to close out, the takeaway from this Q4 print is pretty clear. This is the strongest order book in Eaton's history. They have massive data center tailwinds. And yes, there's temporary margin compression, but it's because they are literally building the factories to service that demand.
And they are finally cleaning up the portfolio with the mobility spin. It sounds like they are doing all the right things, even if it hurts a little bit in the short term.
The volatility today was a classic sell the news on the guidance, but the buy the dip crowd stepped in, because you just cannot ignore an 11-year backlog in the hottest sector on Earth.
So for those listening, keep a close eye on that Q1 margin number. If they beat that soft guidance, the sandbagging theory is confirmed and the race is on. Check your models on those ramp costs. That's it for this deep dive. Talk Tickers out.